No doubt the industry headlines at the moment predicting property market crash, to see a recession, and so many things happening, debt tsunamis. So today we're going to break down everything you need to know about rising interest rates and what could potentially happen to the market. We'll run through what happens when interest rates rise, how things have changed in the past, and what you can expect in the next sort of 12 to 24 months. So Jaden, starting off at the top, what does it all sort of look like?
So if you've seen the news in the last few weeks, it's hard to avoid it that interest rates are obviously going up and look like they're going to go up. But I guess the first question and the thing that's kind of coming in the media more and more is this tsunami of debt and talking about as fixed rates and mortgages end with rate rises, people are risking losing their homes. And it's probably part of this we want to sort of start to look at. So I guess part of the story is, people have sort of fixed their interest rates a couple of years ago on the basis that the Reserve Bank was going to keep interest rates on hold till 2024. We covered it a bunch of times in our videos. They basically said interest rates aren't going anywhere for 4 years. And a bunch of people have started buying properties. Now there's talks in the media in this article, it talks about one company that sort of helps people with housing, they're in housing stress, and they've been contacted by 60 clients, and it's sort of making out that there's this tsunami, there's this huge wave of people coming through who are about to go into default and cause the property market to crash because of interest rates. But if you actually look into the data, it's probably not reflective of the actual situation. So the latest data from APRA shows that $2.2 trillion worth of loans held in March. Of that, $9 billion belong to borrowers who are overdue. It's slightly up from December 2021, but well down from the $14 billion that were overdue in March 2019. So obviously we're still nowhere near kind of where we were previously, and historically sitting pretty well. Even with the banks themselves, the Commonwealth Bank has reported that home loan arrears at record lows of less than 1%, and 1 in 2 borrowers with more than 3 months ahead in repayments. Westpac said 2/3 of customers were ahead of mortgage repayments, and 90-day delinquencies were less than 1%. So it looks like that's not quite, the tsunami that they were talking about in the article. And even looking at sort of Moody's, who's one of the rating agencies, they said like they were expecting, mortgage defaults and sort of repayments to sort of increase slightly this year, but certainly nowhere near what was going to happen historically. But sort of gets to the question on interest rates, and this is the bulk of where the media is focusing on. Interest rates, it's all about interest rates. This is a great article by Select Residential Property talking about sort of the interest rates and the
I think going back to that thing with the media there, Jaden, focusing on interest rates and interest rates alone, what we're finding is there is a two-tiered economy in Australia. You've got Sydney and Melbourne, which in the past has been all the talk where they've had that crazy 10, 20% growth in the last 10, 15 years, and the rest of the states like Brisbane, Adelaide, Western Australia not really being looked into whilst their growth has been moderate. Now we're seeing a flip side where Sydney and Melbourne is starting to slow on growth side, but we're still seeing some pretty good numbers coming from Western Australia, Adelaide, Brisbane, and all those sort of things. So I think that's one thing that the media are really focusing on, is that downwards trend they're seeing in Sydney and Melbourne, which might not actually be affecting the regions or even some other capital cities.
Yeah, interestingly, we've got some data here from the Financial Review which supports that, because it's saying, in some areas, saying the Blue Mountains, even Karratha and sort of regional WA, the asking price is sort of down on previous weeks, so things are sort of slowing down there. But then equally, there's places like the Hunter region in New South Wales, Ipswich in Queensland and Brisbane, Marion in South Australia, where there's more demand. So you've got to remember too with the media, when they're sort of blowing up and saying like there's a property market crash, as we covered in a video a couple of weeks ago with Simon Presley from Propertyology, he talked about sort of, almost 95% of the media outlets and the people that broadcast the media are based out of Sydney and Melbourne. And all they focus and all they're thinking about is Sydney and Melbourne, but it's not sort of looking at all the different areas and all the different parts in Australia. Back to sort of the interest rates, Jeremy Fisher from Select Property Residential put together this piece talking about, if we should be freaking out about interest rates and what's the sort of, if the history has any clues on that. So looking at the Reserve Bank cash rate over the last almost 30 years, we've all heard the stories from our parents where interest rates were in the teens. Obviously they came down in sort of the 90s, and then to today where they're sort of at historic lows. And he sort of decided to examine the parts where interest rates were sort of going up and sort of where property prices were sort of also on the move at the same time, and we'll break this down. So like you sort of said here, rates have been rising for about 9 of the last 31 years. So although a lot of people sort of freaking out now and saying, oh, this seems like I haven't seen it, haven't experienced, like it's completely normal. It's been a part of property and the economy for a very long time. You know, assuming the period, you know, previously interest rates could potentially climb back to 6%. That's not unusual. And all past periods of rate rise have been no more than 3% from peak to trough. So I think that's another interesting point, you know, to sort of factor in there. And another thing that the media is not talking about that we sort of spoke about a bit as well is it's not just about the cash rate. So sometimes the banks will increase beyond this and they'll sort of do the job that the Reserve Bank wouldn't otherwise do. So potentially the banks, you know, in 12 months might end up increasing rates or decreasing, you know, they can do their own thing. They can move independently of the Reserve Bank.
We're seeing this even with the recent rate rises where some of the banks have increased their rates, but their new to bank rates are still lower than the increases. So we're getting rates in the 2.5%. If you got a loan 12 months ago, your loan might have been 2% at the time. With all the rate cuts, rate rises, now you're at, you know, at 3% or high twos, where the banks are offering lower rates, even factoring in these rate rises with all the things going on. So that's an interesting thing to see as well. Like, you know, you might have your mortgage, but reviewing it and looking at ways to get that rate down might actually be beneficial.
Yeah, interestingly, we had one with a customer, an exact example where before the 0.5% rate rise, the bank was giving them a 2% discount off their variable rate. So they were effectively at 3%. After the rate rise, the bank increased the discount to 2.5%. So even though there was that rate rise, it actually didn't impact the borrowing capacity and their sort of net interest rate stayed the same. So interesting how that's kind of getting passed on. And that's where all the talk about the Reserve Bank and that headline interest rate isn't always reflective of what's kind of happening behind the scenes with the banks. Back to sort of some of the data and looking at the correlation to capital growth. And this chart looks at you know, the cash rate over time and the national property growth and how that's sort of gone over. And, you know, obviously we're very familiar with what's happening the last couple of years, sort of post-COVID. But some of these charts looking at you know, the rising interest rates in 95 actually show the growth through that period. And even though you know, the sort of rates hadn't started to drop and then it was kicking off. So it's sort of showing that it's not necessarily correlated to sort of lower rates, means massive property price growth. And potentially, you know, during this growth spurt when sort of the cash rate was actually increasing, as you can see here, the property market still went up. So there's been various parts in history and sort of in the property market where this hasn't necessarily, it's not been as simple as sort of interest rates up, property market going down. And he sort of breaks it down further. And in an interview we actually did with him a couple of weeks ago, he talks more about that sort of imbalance of supply and demand. So at the moment, there's obviously record low vacancy rates for rental properties. So it's impossible, as you know, in a video we did recently, you know, rental prices up 20% in some areas year on year, even 50% in regional areas. It's wild. And there's very low stock on markets. There's not many people selling. And there's relatively strong demand for properties sort of compared to historic purposes. So potentially there's still a pretty tight market because all these things, even though it's a bit more expensive to pay for your mortgage, it's a lot more expensive to pay for other things like your rent and fuel, and people will just potentially cut back on sort of discretionary. So, you know, interesting thing, I think he sort of goes through there, you know, with sort of time to buy as well.
Yeah, and I think it's really hard, you know, with this data here. Yes, every suburb is different. So even in Sydney, you know, where it might be going backwards, one suburb could be outperforming from another suburb. We've seen that in the market before, where people are going to open homes and properties are selling quite quickly in one area, and in another area they're finding that they have plenty of time. So I think it is really suburb by suburb, state by state, changes quite drastically. But what we do know is even with rates rising, there's still a bit of activity. We talked about the rental market and that struggle at the moment. So people are looking for reprieve because being in a rental property, they've seen 20% increases even on their rent, whereas, you know, having a mortgage where you can reprice it and reassess it every sort of 6 to 12 months can be that reprieve that people are looking for. So I guess, Jaden, talking about house prices falling here.
Yeah, and I guess this is the thing, like if it were to come to pass, and yeah, in some areas in Sydney and Melbourne where prices sort of shot up extremely and, you know, had some 20-30% growth last year, a 10% fall in prices potentially only take them back to last year's price levels, like 2021 levels. So I think sometimes it can be, you know, concerning. It feels like scary, something in your mind that prices may come off, but like as we've sort of spoken about before, and as we've sort of shown some charts, with property, it's about sort of your time in the market, not so much timing. So whether or not prices go up, down, whatever in the next 12 months, really no one knows for sure. But I think the piece that gets missed in the commentary is it's not just about one factor in the property market. There's so many things involved there.
So I think what's interesting, if we cast our mind back to when COVID happened, you know, all the media, all the experts out there were predicting a property crash. Now, even if someone did say that they could see property growing with all the stimulus and things that happen, they got zero airtime. So what I usually find in these times is the negative news travels and resonates a lot better than any positivity. So as Jaden said, it's really hard to predict. We know property goes through a cycle where it booms, it busts, it recovers, and every 7 to 8 years we sort of see, or 9 years we see that cycle. So really it's about the long term. If you're buying and you can hang on to the property and you see a 10, 15, 20 year journey of keeping that property, whatever happens in the short term is completely out of your control. So having that longer term view is quite important.
Yeah, so that's it for today, guys. Thanks for watching. If you want to hit us up, how do you find us?
Yeah, so guys, if you're looking for assistance, we're a mortgage broker in Brisbane. We help people Australia-wide. So call us. We're based in Brisbane, work with home buyers, first homeowners, investors, anyone looking to refinance. Call us at 1300 088 065 or visit us at huntergalloway.com.au, and we'll see you next time.